And of course, in the midst of what's happening in the markets, the turmoil of sorts that you do call it, and especially in the broader markets, we on ET Now had the man who called the Midcap pullback, that's Samit Vartak of SageOne Investment Advisors. And he believes that the current correction seen in midcaps is a normal occurrence in a bull market, and he expects to see further correction in certain bad quality midcap stocks. Listen in.
When there is a huge bull market, and if you have new investors who have never really experienced, the big cracks. I mean, this is a crack which is really normal. But if you had experienced the 2007-8 crack or the 1999 crack, you have very different learnings. But if you just live through a raging bull market, your learnings are very different. You tend to think that what you did enabled you for the returns, whereas you would see that each and every strategy works. You don't know whether it was the right strategy or not.
So don't confuse brains with a bull market. 2017 was a euphoric market, largely unleashed on the legs of liquidity. That has turned.
Exactly. Because in a bull market, the returns generally come from the re-rating of the valuations. The re-rating happened 3 to 4x without really change in the fundamentals.
Okay. So is the darkest dust getting over? There is a scope for mid and small cap stocks to revive now, or this is going to be a long night and a big winter?
I feel that compared to 6 months back, this is an environment which I really prefer, because you imagine, today people are worried about anything and everything. I talk to the most sophisticated investors, and most of them are worried. I haven't spoken to a single investor in the last couple of months who is positive about the Indian markets. There is pessimism all around, and that's an environment generally which is really good for investors to come in. I mean, imagine last 2 quarters have been few of the best quarters of earnings growth in the last 6 years, I would say, and especially for good quality companies.
But a classic compounder for Indian market has been HDFC Bank.
Right.
You may call it overowned stock. You may like to call it a stock which has enjoyed strong P multiples and strong price to book ratios. Yes. That bank has never given you bad news.
Right.
So here's one stock which has been a classic compounder despite giving you bad news, despite being a consensus buy. And whereas for those who try to buy PSU banks or corporate banks at every cheeky fall and who trying to time cycles, they've not made money. Right. So how does this theory work? I buy your argument that you should not chase cherry consensus.
Sure.
You should go against overowned stocks.
Right.
But HDFC Bank or in Bajaj Finance, they defied the logic.
Right. I mean, you are right. You will never go wrong in the HDFC Bank or Bajaj Finance. Question is, what are your targeted returns? If your targeted returns are 15-20%, it's best to hide in such stocks. Because there's no need for you to take extra risk. If such companies are going to give you consistently 15 to 20% return, and 15 to 20% return is not bad. It's pretty good compared to the other asset classes.
You're talking about stock market returns, not earning returns.
Right.
Okay.
Yeah, I'm talking about stock market returns. Question is, I think such opportunities give you, the potential to make much higher returns. There are companies which are growing at 30% plus today, and which are available at less than 17, 18 times multiple, and this current year's multiple. So I feel their fair value is much higher.
Do you own private banks? Do you own consumer names? Do you own staples in your portfolio?
I do not. I used to own many of those, but for me, valuation is extremely important, and I don't find value in those stocks.